everybody, and welcome to what I promise is going to be an absolute treat. A debate in partnership with the Harvard Law School program on corporate governance and London Business School and the Center for Corporate Governance to discuss a question which is actually taking up a lot of attention and interest, not just amongst journalists like myself, but also groups like most of the major business entities and many corporate boards as well, not to mention investors. And that question is, of course, whether it's time to move from a shareholder vision of capitalism, which was espoused by Milton Friedman so famously 50 years ago, or whether it's time to embrace a kind of stakeholder vision that the Business Roundtable in America surprised people by coming out last summer and adopting instead. Now, I know there is passionate interest and strong feelings on both sides around this because the Financial Times has been covering this pretty intensively for the last 18 months. And in particular, we have a dedicated platform called Moral Money, in case any of you haven't seen it yet, which covers these issues about environmental, social governance questions and stakeholder capitalism in a pretty detailed form through a newsletter and a platform. And we know, just by looking at the uptake amongst our readers, which has been huge, that people care a lot about it. However, we also know that there's actually very strongly divided views about the merits of this. And what we have today is two of the leading thought leaders in the sector who are going to be debating it. On the one hand, we have Alex Edmans, who's Professor of Finance at London Business School, and he's the Academic Director of the Center for Corporate Governance, and he's the author of Grow the Pie, How Great Companies Deliver Both Purpose and Profit, which, as the name suggests, indicates he's a very strong supporter of the stakeholder vision. On the other side of the debate, we have Lucian Barr, Bebchuk, who needs almost no introduction, who is the James Barr Ames Professor of Law, Economics and Finance and Director of the Program on Corporate Governance at Harvard Law School. He's the co-author of the piece, The Illusory Promise of Corporate Governance and For Whom Corporate Leaders Bargain. And as that title indicates, he's somebody who is very cynical about the value of stakeholder governance and prefers us to focus on shareholders instead. So we have contrasting views, which is terrific. And we're going to basically have each of them present their arguments for some time and then have a debate between them and give you all a chance to ask questions. I'm going to start by asking each Alex and Lucian to give a brief overview of their views on the topic. We'll then have them reacting to each other in 2 rounds. And then I'll ask questions and bring your questions in as well. So please do start by asking your questions up front as soon as you want to, because I will try and use that to inform the questions that I ask, and then, of course, lob some of your questions directly at them. So let's get started. Over to you. I'm going to start with Alex, who's going to tell us why it's time to look at stakeholders, not shareholders.
Well, thanks so much, Gillian. It's great to be partnering with you and also the European Corporate Governance Institute on this really important debate, and great to discuss it with someone I truly respect. So while Lucian and I might have different views, I look forward to learning from him as well as giving my own perspectives. So I think a good place to start is just to agree on some potential common ground between Lucian and me in order to frame the debate. So I'm going to first assume that the responsibility of a company is to act in shareholders' interest. So I know that there's a debate as to whether the legal liability and the duties are for stakeholders. So people like Lynn Stout have written on that. But just to frame the debate and keep it in focus, let's assume a company should be run for shareholders. So I'll give that to Lucian's camp. And the second thing to do is to have a clear definition of stakeholder capitalism to know that what we're debating about, because this is indeed a big movement around this, as Gillian says, but there's no official definition anywhere in any dictionary and not even on Wikipedia. So I'm going to adopt a definition both in my book and also which we've developed with the Enterprise Engagement Alliance, which is that stakeholder capitalism seeks to create shareholder welfare only through creating stakeholder welfare. So let me pick apart this definition briefly. So the final 3 words here won't be too surprising. It's about creating stakeholder welfare. But I think the more important part is that also the first three words create shareholder welfare through creating stakeholder welfare. So why is that important in terms of a definition? So often we think that the value that a company produces can be given by a pie, and that pie can be given either to shareholders or stakeholders. And we often think that stakeholder capitalism means taking part of the pie away from shareholders and giving it to stakeholders. Instead, this view of stakeholder capitalism is that we do want to increase the orange, but the way we do that is not by splitting the pie differently and perhaps trampling on shareholders, but by creating value for both stakeholders and shareholders alike. And so why do I want to adopt that definition? It's because if stakeholder capitalism is going to be taking hold, it will actually be sometimes shareholders who are going to ensure that managers will act in accordance to it. And obviously, if it's something where they might reduce their blue, their slice, they might not have an interest in doing so. In addition, obviously, shareholders play a really important role in society in terms of producing returns to pensioners and shareholders and so forth. Okay, so the other important thing, because you might think, well, how is that different from shareholder capitalism? It's the words only through. So what I view is stakeholder value as the end goal, and then shareholder value as a byproduct of a company serving its purpose, rather than the opposite of the end goal being shareholder value, because then you could pursue it by price gouging customers or mistreating workers or polluting the environment. So we want to create value for society, but if we do that, shareholders will also be better off. So there's only two arguments that I'm going to focus on in my opening remarks. So the first argument is that surprisingly, even though profits are not the end goal of stakeholder capitalism, actually profits might be even higher than if you pursued profits directly. So why might this be? So let's first start with what shareholder capitalism argues. Now, often people would argue that shareholder capitalism is all about the short term, making profits and not caring about society. But that's actually not true, right? Even shareholder capitalism takes very seriously the need to invest in stakeholders, right? Because the only way that you can make profits in the long term is if you are to invest in your workers, not pollute the environment, and develop a brand. However, with shareholder capitalism, when you make these decisions, you make them instrumentally with a calculation. And that's indeed what finance professors like me have been teaching for the last 50 years, right? We do a net present value analysis. And that works in many cases, right? If I'm going to build a new factory, I can estimate how many widgets the factory will produce, how much I could sell the widgets for, and compare that to the cost. And if it's positive, I'm going to do that. But the problem is that in a world of uncertainty, this instrumental way of making money doesn't work because it's really difficult to put numbers on various things. So let's say as a company, I'm going to think about whether to give more parental leave to my employees. Can I calculate, well, how much more productive the workers are going to become and how much money I'm going to make? That's going to be extremely difficult. So a narrow view that we can only take decisions if we can estimate the effect on shareholder value might mean that a company actually ends up not taking many decisions that ultimately increase shareholder value because you want to have a loyal and engaged workforce, just because in a world of uncertainty, we could not have predicted those channels from the outset. So this is why I think even in a world in which a company should be run for shareholders, stakeholder capitalism offers a useful decision rule in the presence of uncertainty. It's practically more useful. And just to give an example of a company, so Vodafone in 2007 launched M-Pesa, which was a mobile money service in Kenya. It's then become extremely successful and also profitable for Vodafone. But at the time, had they calculated how much they'd be able to monetize this for and would it be worth the investment, they probably would not have gone ahead with that decision. Right, at the time, Vodafone's strategy was to win spectrum license auctions in the West because the West is where there's a lot of money to be made. But instead they had a purpose to build a digital society that enhances socio-economic progress. They decided to launch this because financial inclusion was, and still is, a major challenge in Kenya. And then after doing that, they ended up monetizing it. But it was something that it would have been very difficult to have predicted the benefits from the outset. And so what is the evidence for this? Is it just too good to be true that if we serve stakeholders, shareholders might actually benefit ultimately? But there is indeed quite a lot of papers showing that stakeholder capital and other forms of intangible capital ultimately improve shareholder value. And importantly, a lot of these measures are public information. So if the market was efficient and rational, then when a company is, just to take my paper, listed on the 100 best companies to work for in America, the stock price would immediately go up. But what we find is that the stock market does not react to this, and therefore companies that have high values in terms of the stakeholder metrics do well on the long term. So if even many investors don't recognize the importance of various forms of stakeholder capital for shareholders, it may well be that many managers don't recognize this, and therefore if they took an instrumental approach to shareholder value maximization, they won't be engaging in these investments. And then just to go to my example of paid family leave, in fact, there's a very nice new paper on this, which looks at what happens when a state mandates parental leave. Now, if managers were fully rational, there'd be no need to mandate paid family leave, right? The managers would know that if I do this, my employees will be happy and more productive. But interestingly, what the study found was that this mandatory law to force some firms to provide the leave that they might not otherwise have done actually improved shareholder value and profitability, not just the working conditions for the employees. Okay. So we still need a decision rule. So one of the arguments that Lucian's made in his writing, which I really respect, is that we still need some accountability. But the fact that we're moving away from net present value as the only way to evaluate investments does not mean that we're just swinging in the wind and it's a free-for-all. One thing that I develop in the book is a couple of decision rules that a manager can use to decide whether she should take an investment or turn it down. But I think the idea of using principles rather than rules or calculations is something which is more useful in a world of uncertainty. So the second reason why I think there might be a reason to go for stakeholder capitalism is there's a big difference between shareholder wealth and shareholder welfare. And this is a point made by Hart and Zingales, but let me just explain it for those not familiar with their arguments. So why do I invest for the future? It's not because I'm King Midas, I want to have lots of money because I just enjoy money. It's because I care about my living standards in the future. And certainly my living standards are affected by how much money I have, but they're also affected by, is the planet 2 degrees warmer? So it's indeed in my own interest, selfish interest, to make sure not only my returns are decent, but also the planet is not 2 degrees hotter. So it may well be that shareholders will willingly be happy with their company, reducing some profits and investing some profits in order to boost some stakeholder value. So you might sort of be at odds with the pie growing idea that I mentioned previously, which suggests that shareholders and stakeholders are always aligned. There will be cases where there's not full alignment. So if a company decarbonizes, right, maybe that will improve employee morale and customer purchases, but maybe it won't. So sometimes companies will have a trade-off between the left and the right. So the right, the pie is bigger, but shareholder slice is smaller, maybe because they've invested to improve the carbon, to reduce the carbon footprint. However, because shareholders also might care about the orange, they might care about society because it affects their living standards, it may well be that they support actions to invest in creating shareholder capital, even if it doesn't ultimately show up in returns. So the evidence of the last slide says that most things that benefit stakeholders also might benefit shareholders, but that's not always the case. And Lucian and Rebuttal have made a really important point that this needs to be accountable. Like a manager can't just decide on a whim what social causes she wants to support. But there are ways of acting within the realm of shareholder accountability. Tom Gosling and I just released something in the Wall Street Journal on Monday showing that if we have this idea of say on purpose, that if a company would like to pursue stakeholder value, they can run it past shareholders and have a vote on this. And that's a way of pursuing other goals, but still with the legitimacy of shareholder support. Okay, so just to wrap up, so what we're talking about here is stakeholder capitalism, which is not anti-shareholder capitalism, right? Reducing profits or taking from shareholders, splitting the pie differently. Nor is it managerial capitalism. Is this an excuse for managers to make decisions without any accountability to shareholders and pursue whatever social causes she would like? Instead, I'd argue that stakeholder capitalism has two important benefits, even in a world in which we believe companies should be run for shareholder interests. The first is it has practical value in increasing shareholder wealth, because there are many decisions that might ultimately pay off in terms of long-term profits, but in a world of uncertainty, we could have never forecast that from the outset. And the second is that shareholders might care about more than just shareholder wealth, they care about welfare. And if indeed managers are to take shareholder input into this, it may well be that they have the legitimacy to pursue goals other than shareholder value. Okay, thanks very much for your attention. I look forward to hearing Lucian's arguments.
Well, that's fantastic. And thank you, Alex, for keeping to time. Thank you to all of you in the audience watching who have already sent in 17 questions. So we know there's a lot of passion here. One of the questions, of course, is, will the slides and these presentations be available afterwards? And I believe that they will be. Anyway, Professor Bebchuk, over to you.
Yes, so thanks. I'll talk with you about why I believe the promise of stakeholder capitalism is illusory. It's based on the writings that Gillian mentioned, available on my website. To relate this to my where I can be situated in this debate, Gillian viewed me as cynical. I would view myself more as a skeptical viewer of stakeholderism. But I want to emphasize, and it will become also clearer in the course of the presentation, that I'm not really a supporter of shareholders or shareholder wealth. Indeed, I might be one of the people on in this forum who would be most supportive of measures to impose constraints on companies in order to help stakeholders. So I'm a big fan of stakeholders. I just don't think, for the reasons I'll explain, that stakeholderism, stakeholder capitalism is the way to do it. So should corporate leaders serve goals other than maximizing shareholder value? Stakeholder capitalism, or what I call quote unquote stakeholderism, supports this. I don't think that this is the way to go. So my goal is to introduce in this discussion some realism about what stakeholderism can accomplish. I'll suggest to you two things. One is that stakeholderism should not be expected to produce material benefits to the intended beneficiary stakeholders. And secondly, that illusory hopes about stakeholderism would be costly to stakeholders, shareholders, and society at large. What we need, as I mentioned, I am a fan of stakeholders. What we need is capitalism that does work for stakeholders. Many of us recognize that public companies impose substantial, significant externalities on stakeholders, issues like climate change, inequality, and the like. But for capitalism to work for stakeholders, the most effective way is to adopt rules that would operate from outside the companies and would constrain and incentivize corporate leaders in this way. What we have coming from a bandwagon of business leaders is an offer to use stakeholderism, having corporate leaders take care of the matter as a remedy for corporate externalities. Gillian mentioned the Business Roundtable, there is Davos, Larry Fink, and so forth. There are competing versions, which I think we should all recognize for stakeholderism, and sometimes people do not separate them. In our work, we distinguish between pluralistic stakeholderism, where corporate leaders are supposed to give independent weight to stakeholder interests and balance them with shareholder interests. And then there is enlightened shareholder value. That's really a principle that was incorporated in the United Kingdom Corporate Code, which recognizes that it's important to pay attention to stakeholders, but only as an instrument to serving long-term shareholder value. I'm going to present why we are skeptical about this whole family of versions. Later on, I'll discuss perhaps in more detail the particular version, particular mix that Alex is supporting. But we believe that neither version would produce material benefits to stakeholders. Now, clearly, stakeholderism has a significant appeal at first glance. It relies on private ordering rather than regulation with its problems. It aims at harnessing the power of the private corporation, which has been successful as an engine for economic growth. Tries to harness this to deal with the externalities that companies impose. And to do so, generally stakeholders argue, while leaving basic corporate structures intact, in particular, the power of shareholders alone to elect directors. But would stakeholderism deliver? We have a very detailed analysis of the systems of incentives within which corporate leaders operate. And our conclusion is that corporate leaders have incentives not to protect stakeholders beyond what would serve shareholder value maximization. And therefore, we should do one of the following. Either we should think about changing basic corporate structures from which those incentives arise, which we explain would be quite costly, but it's something that people could consider. Or we should recognize that with basic structures remaining in place, with basic systems of incentives, the promise of stakeholderism is largely illusory, and I will suggest to you even counterproductive. A word about the business roundtable that, as Gillian mentioned at the outset, attracted major attention, was described widely as a major milestone, as a sign of coming shifts in how stakeholders are going to be treated. But in our academic work, we provide several pieces of evidence that show that the statement was mostly for show. For example, we did a survey of all corporate signatories of the statement, and this survey indicated that CEOs generally joined without seeking board approval, either in advance or afterwards, which is consistent with CEOs perceiving the statement as not requiring and to be followed by any meaningful changes. We offer a test, an empirical test of whether stakeholderism can be expected to deliver significantly. We argue that a good setting for testing is to look at the acquisitions of companies in states in the United States that have constituency statutes. Those statutes introduce legally in a binding fashion a stakeholderist regime, what stakeholderists want to have, by authorizing and encouraging corporate leaders to take into account stakeholder interest when they make M&A decisions. What did we find? We found that corporate leaders use their power. We looked at the whole universe of such transactions. They use their bargaining power to obtain significant benefits to shareholders, large premia, and for corporate leaders themselves, monetary payoffs and continued employment. For whom corporate leaders did not bargain, generally, they did not negotiate at all for constraints on post-deal laying off of employees, despite the well-understood phenomenon of significant firing post-transaction. and we find no negotiated terms for protection of suppliers, customers, communities, or the environment. Now, some who care deeply about stakeholders, and I'm sure there are many in the audience who classify themselves in this way, as I do, might take the view that even if stakeholderism cannot be expected to benefit stakeholders substantially, it cannot hurt. It might move things in the right direction, either in an atmospheric fashion or some other way. However, the reason why we are concerned about this is that we believe that stakeholderism and the growing support for it would be expected to produce two major costs. The first cost is increased insulation and reduced accountability. Acceptance of stakeholderism, we worry, would insulate corporate leaders from shareholders and make corporate leaders less accountable to anyone. And indeed, it seems that some stakeholderists, or at least some management advisors who are urging stakeholderism, are partly motivated by this insulation and reduced accountability effect. Stakeholderists urge institutional investors to be more differential to corporate leaders in the name of stakeholderism, to be more accepting of arrangements that insulate management from market pressure. This kind of insulation would raise slack and underperformance. It would benefit the private interest of managers, but no one else. It would reduce the pie that is available to shareholders and stakeholders. The second type of cost is that acceptance of stakeholderism raises illusory hopes that corporate leaders would protect stakeholders on their own, and we can rely on this to address some of those problems. And we worry, and we detail this worry in our writings, that this could substantially chill or impede efforts to obtain regulatory reforms that could produce real benefits for stakeholders, not benefits that are cosmetic or largely illusory. And to the extent that believing that stakeholderism would contribute materially to saving the planet would reduce the chances of passing, or the magnitude of passing, a carbon tax or any powerful arrangements to deal with climate change, this would be very costly and should be a concern to anyone who is a fan of stakeholders. So let me conclude. To protect stakeholders and the planet, if you are concerned about those, what is necessary is to constrain and incentivize companies through external rules. It might be costly to shareholders, but it would be the right thing to do socially, rather than count on corporate leaders to address those problems on their own, which I suggested to you is not going to happen in a significant way. Therefore, I propose stakeholderism should be rejected, even by those like myself who care deeply about stakeholders. Thank you.
Well, thank you both very much indeed for a very trenchant set of ideas. We have almost 50 questions, which indicates a level of passion around this. And frankly, I think there's scope to have a follow-up event because the questions are truly excellent. I've been looking at them all just now. What I find fascinating is that both sides, Alex says he loves shareholders, but thinks stakeholderism is the best way to basically support them. Lucian says that he loves stakeholders, but thinks that actually talking about stakeholderism is not a good way to support them. So we're all being very nice to each other. Alex, over to you to reply for 2 minutes, and we will have to be quite strict about timing on what you think Professor Bebchuk has got wrong.
Okay, well, I'm afraid I'm going to start with the spirit of niceness by saying there is some stuff that I fully agree with. So Lucian talked about the BRT statement and also the analysis of constituent statutes. But because we promised a debate, so let me say, well, why I don't think that really gets to the point is I'm not sure that those are actually tests of stakeholder capitalism. The BRT statement, I agree, is problematic, but that was just some statements. It could be for marketing. These constituency statutes, that's something which is legislated. There's a question by Nan Kumar Nair, who I agree with, that you can't really legislate stakeholder capitalism. Instead, I'm saying this is not something we legislate, but it's a mindset shift. It's a practical decision tool to help with decisions in the face of uncertainty. So I just asked Lucian, do you agree or disagree with the idea that having other objectives can have some practical benefits? So let's just think sort of how we go about our lives. So I don't know what the objective is of a professor. It's clearly not wealth, but let's say it's impact, right? But if we went around every day thinking, well, how can we maximize our impact? We probably wouldn't do things like overinvest in teaching our students or journal refereeing and so forth. But unexpectedly, if we go above and beyond in our teaching, well, we actually learn a lot from actually teaching, which we might not have expected. Maybe people we end up teaching become sort of good leaders in the future, and then we have some relationships with them. Maybe through journal refereeing, we become great writers ourselves. So do you think there's ever any argument that by seeking to create value for society, ultimately we might benefit ourselves, even if that sort of selfish benefit was never the motivation for the altruism?
Thanks. Also, in the spirit of niceness, let's say that I'm delighted to have the opportunity to discuss this with Alex, who is one of the very most thoughtful people who articulate a stakeholderist view. Now, on the question, and Alex makes a very interesting argument that talking and reminding and pressing the issue of stakeholder interest is a good way to lead corporate leaders to maximize a long-term value. And that might have been the motivation behind the section in the United Kingdom Code that reminded corporate leaders that this is a relevant factor. Two things about this. One is that supposing for a moment that your method would indeed get us to lead corporate leaders to make decisions that would somewhat be better for long-term shareholder value. I want to stress for the many people who are in this audience because they care about stakeholders, that I think that this would be a limited effect for addressing the problems that motivate this discussion. The reason why I was told we have 1,400 people in the audience, and that's because people think that this is a normative issue. It's not just a managerial theory, like we have sometimes managerial theory about how to deal better with this or that strategy, and we can explain to executives how to do that, but something beyond that. And my concern is that even if managers do better in terms of choosing decisions that maximize long-term value, most of the problems that concern people, like climate change and inequality and problems with blue-collar workers, are not going to be addressed, because even though you and many other in the stakeholder side stress that there are very often win-win choices, you have those beautiful circles that we can expand and everybody benefits. Unfortunately, in economics, we have real trade-offs. In many situations, it is in the long-term interest of companies, even taking everything into account, to do things that would be bad for climate change, to move factories offshore to the detriment of employees and so forth. So for the many people who come to this, I just want to make clear that they should recognize that we are not going to address the problems. Secondly, I'm somewhat skeptical about how much this idea of reminding the corporate leaders about this factor is going to have an effect. Why? Because on many other choices that corporate leaders make, we assume that we should just give them the right incentive, in this case, tie their interest to long-term value, as both you and I have written at length, and then rely on them to make the right choices, knowing that they have superior information. Now, now you are saying this is an area where effects are uncertain, but there are many other business decisions. For example, branding and marketing and advertising, those are practical effects. But nobody is suggesting statement or branding. Nobody is suggesting let investors explain to them. Yeah, I see that Gillian reminds me that I should stop, but the basic point is that I think we should apply the same principles here that we apply elsewhere. And what we should do, the best way to be doing this is not to keep reminding them, but rather give them powerful incentive to maximize long-term values in the way that you and I have suggested, and then defer to them as we defer to them on many other business decisions.
Right. Well, thank you. Well, in the interest of being nice, and probably we're all being a bit too nice right now in the new spirit of stakeholderism, I want to give Alex an equal amount of time. So Alex, can you respond to Professor Bebchuk?
Yeah, so I'm saying here, it's not necessarily that we need to impose some sort of stakeholder objectives on managers. I'm saying that maybe managers themselves should voluntarily adopt some stakeholder objectives because it helps them with decision making. So how does a manager every day, if she goes into the office thinking, how do I maximize shareholder value? It's very difficult to translate that into day-to-day strategic decisions. But if, let's say, you're managing an energy company, and I think, well, we need to decarbonize, but to have a just transition, which is not going to make redundancies too fast, I think that's a much sort of easier and clearer way to have decision making than saying, how can I rub my hands together and sort of maximize shareholder value? Because in a world of uncertainty, we can't predict the impact that many actions have on shareholder value.
I agree. Look, I completely agree that if you want to have an executive education program at the London Business School where managers would come for 2 weeks and we'll explain to them that human capital is immensely important, that's great. What I question is, one, how much of a difference this would make? And secondly, for people who are concerned about stakeholders, I doubt that this would move the needle much. And the last sentence I'll say is that Gillian said, I'm in favor of talking about stakeholders in the spirit of niceness, but actually I'm in favor of talking about stakeholders a lot, but talking about stakeholders in the form of carbon tax, talking about stakeholders in the forms of legal rules that would protect employees. I'm not about talking about stakeholders in the type of discourse we have around stakeholderism, which I think is not going to deliver.
Right. Well, we're going to move to the next section. Sadly, we have very little time. We have about 72, in fact, we have 72 questions, which frankly, I would encourage you all to have a look at if you're watching, because they're fascinating. And I really do think the organizers should think about a follow-up session. But I'm going to ask a couple of quick questions, which I'd like to start with Professor Bebchuk. Since Milton Friedman drew up his ideas 50 years ago, to my mind, 3 things have changed. Firstly, he lived at a time when people thought it was entirely practical and sensible to outsource decisions to government. And in many ways, you're suggesting that should be done again in terms of looking at government imposing rules on companies. Today, credibility of government and trust of government has collapsed, which is one reason why people are looking at companies. So I'm curious to ask you, what you think about that. Secondly, we now live in an era of radical transparency when, in fact, the customers and employees and clients and others can watch what's happening and complain about it in a way that can impact shareholder value, which we didn't have before. And thirdly, we have a world where the wider social zeitgeist has changed radically from 50 years ago. So I'm curious, Professor Bebchuk, if Milton Friedman was around today, do you think he would be embracing stakeholderism for those 3 reasons? You can't outsource tough questions to government. You have radical transparency, and you have people who are using radical transparency to demand things or else take away their business.
Yes, I think that I did not know Milton Friedman firsthand, but I think anyone who knew him would tell you that if he lived today, he would say exactly the same things he said then. Uh, the way in which I think he was wrong, but it would be first order point for him, was that if you look again this article, you see that a lot of it is driven by his view that the shareholders own the corporation, it's their money, and anything that is done by the managers in a stakeholder direction, that's kind of violates the rights. From my perspective, I don't have this view that is really rooted in property. If we think as a society that it would be better to run companies in such a way that we would help stakeholders and reduce shareholder wealth to combat, let's say, climate change, I would be all in favor of heavy regulations. Milton probably would not. Now, you mentioned um, the the fact that there is now also effects that come from consumers, employees, and so forth. Now, that's a different route and deserves maybe another debate, and one doesn't need to have the same view on this. So somebody might think that stakeholderism doesn't work, but consumer boycotts might work and employees walkouts might work, or vice versa. The two are really, they are motivated by similar good intentions, but they don't operate in the same way. I personally think that for many companies, consumer and employee pressure is not going to do it, and happy to discuss it, but I should probably stop.
Right, right. By the way, I should say that some attendees apparently can't see the questions. The questions are truly fantastic. We now have almost 7 dozen questions, which means that by my calculation, half the audience are watching, or we got 700 people watching. So more than 1 in 10 have asked a question. I think we should try and collect them together and send them out and have a follow-up at some point. But Alex, I'd like to ask you, how on earth does a CEO decide what aspect of stakeholderism they should actually focus on when there's 12 different elements of stakeholderism at any one time? And how do you stop it becoming just a pet vanity project or pet virtue project on the behalf of the CEO, given, as Professor Bebchuk has shown, or Lucian has shown, that actually, I think it's only 2% of the companies who signed up to the BRT statement actually asked their board about it, which is very striking.
Yeah, I think this is a really important question, and this ensures that it's in the interest of stakeholders and shareholders, not just the CEOs. So one, I think, is the principle of comparative advantage, is that out of all of the stakeholder issues that a company can deal with, these should be issues that it's really well placed to do. So that's why I would agree actually with Milton Friedman that donating to charity is not a company's comparative advantage, because can Apple decide which charitable causes are better than if it was to give higher wages to workers or higher dividends to investors, and then we decide? But let me give you an example that satisfies comparative advantage. So Coca-Cola has this initiative called Project Last Mile, where they make medicines available everywhere in Africa, including the difficult last mile to a rural school or hospital. And why do they do that? They have great logistics expertise because they need to make Coke available everywhere. And also Coke you need to transport in a refrigerated form, and vaccines you need to sell in a transport refrigerated as well. So that's a great example of using something to address a challenge that only their expertise can address. And so when it's linked to comparative advantage, I think it's critical. The second is materiality. So out of all of the stakeholder issues, which are the ones that most matter for that company? There were some questions on diversity from the audience. And while that matters in every organization, I think particularly in an innovative organization, we need to care about diversity, and also diversity of thinking, and also a culture that embraces failure and some left field ideas. So that might seem that even though maybe every organization should care about diversity, particularly if you're in an innovative industry, that's something to focus on. So comparative advantage 1, materiality 2.
Right. I see with my sort of anthropologist brain, I've unconsciously picked up the cultural patterns on each side of the Atlantic. And so I keep calling Lucian Bebchuk professor, because that's what you have to do in America. And I keep calling Alex Alex, because in London, people don't use titles. So Professor Edmans and Professor Bebchuk, I'm going to answer some questions from the audience. One of the constant themes in the audience is, does any of this work without transparency and agreement on standards? And what about the question of liability or the potential risk that companies are going to be hauled over the coals for promising things they cannot possibly deliver? What about the danger of, say, the liar's discount, as someone has pointed out? Professor Edmans, why don't you tell us about that first?
Yeah, well, I think transparency is important. You need to measure how much value you're creating, otherwise they're statements. So there's certainly comparability in some measures, and I call them the do no harm measures. So carbon emissions, water usage. But if we think about responsibility as actively creating value, that the measures will differ from company to company. So Unilever, they might say we're going to try and get hand washing to 1 billion people. Maybe Dodler Dairy will say we want to increase the incomes of our farmers by a certain amount. So I think we should have metrics, but the metrics should not necessarily be comparable because different companies have different purposes. Companies should say, well, this is our purpose, this is how we're going to measure it, and then report according to that. And then the liar's discount that you mentioned, I would like some companies to miss their metrics, right? The one way in which you can make sure that you hit every metric is you're just not ambitious to begin with. So Paul Polman had this great interview where he talked about the billion, and they missed it. They helped, I think, 850 million before he retired, but still that was a great achievement. So I think we as a society, we love to play gotcha and tell companies off for not hitting targets. But actually, we would like companies to have targets which are so stretching that sometimes they will miss them. But if they explain why and what great good they still manage to do, I think that's a good way. Because if we focus too much on the liar's discount, then companies will just stick with the status quo and not have ambitious targets.
Right. Professor Bebchuk.
Yes, to me, I can see that standards might help on some margin, but it all doesn't work because of the fundamental issue of incentives. When you just now asked Alex, what's the decision rule? He gave, and in his book, he develops it more. He has a very rich account of what's the best quote unquote decision. But when I listen to it, I say it's all good, but do corporate leaders have incentives to follow this? And my answer is no, because the incentives they have are different. And therefore, the problem with the standards is twofold. One, a key point of Alex was that these issues are uncertain, are hard to measure. That's why we need to continually remind corporate leaders to have them in mind. So standards are going to be very difficult. And two, because if the people who are going to make disclosures don't have the right incentives and they are armed with talented advisors, what we might end up is getting text which has a lot of high language and perhaps some numbers thrown here and there, but it's not going to deliver results.
Right. I say someone's pointed out a rather interesting detail, which is, apart from the fact you both come from different countries, Professor Edmans is professor of finance and is looking at value and what's going to create value, and Professor Bebchuk is professor of law and is looking probably
also
more
at economics and finance.
Okay. All right. Well, okay. I would in that case correct the comment then made by one of the people watching. The questions keep coming in. One of the constant themes in these questions is whether we should be actually looking for regulation, government regulation, to be achieving these aims, or companies' own will or desire or voluntary decision making. And one of the questioners have pointed out that, say, with Uber, basically they won Proposition 22 to deprive gig workers of labor rights, which suggests you can't necessarily rely on governments to actually uphold these types of things. I'm curious, do either of you have any confidence that governments are going to respond by this change in the zeitgeist by getting a conscience and, most importantly, getting more effective? Because again, as an anthropologist, I'm always trained to look at context. Milton Friedman developed his ideas after governments had won World War II and were essentially presumed to have the right to shape things and the ability to execute it. That's not the case now. So anyone believe that we're going to start rediscovering our love affair with government?
I'm happy to start with this. I think regulation does play an important role, and as some of the Q&A suggests, it's not an either-or thing. It's not either just the government or companies. I think we would need a bit of both. And there's certainly many things that regulation is very good at, particularly things that can be measured. So you could tax particular things that might be harming society, be this a sugar tax or a carbon tax, and you can ban certain activities, let's say child labour, which are clearly going to destroy value for society. However, there are many things that actually can't be regulated because it's difficult to measure this. For example, can we regulate meaningful work and skills development? And we know, for example, a former FT Book of the Year, Janesville, shows that when GM doesn't invest in training the workers, when they close down a factory, this devastated the whole town. So then I think the other role for regulation is to help markets work better by encouraging competition. Because one regulator is actually us as consumers and investors, right? We can walk away from companies that don't serve wider society. I don't think that's fanciful. People are paying more for organic food or for locally sourced food, but it's difficult to walk away from a irresponsible company if there's not other companies to move towards. And this is one of the problems with Tett, for example. So if regulation also helps market forces work by trying to encourage a competition, then that's also something which I think can help market forces work. So it's not an either or. Good regulation can also help markets achieve the outcomes that we're discussing.
Right. Professor Bebchuk, we're almost out of time. So
sure. So I think that the perception that there is gridlock and it's difficult to get governments to adopt reforms is partly what motivates people who are concerned about the problems we have with capitalism. It kind of motivates their interest. If this is not working, maybe we'll find this roundabout private ordering way. Two things about this. One is that a main reason, and that this is, I think, paradoxical, a main reason that is given why we have gridlock, why it's hard to adopt reforms, is that vested interest, businesses lobby and put pressure to prevent them. But what's kind of ironical is if that's your view, then why should you expect the very corporate leaders who have been stopping regulations to not only stop doing that? I think maybe we should try, first of all, to have them stop doing it before doing other things. But why should you expect the same people to take care of stakeholders on their own? Secondly, I think that it's difficult to get government reforms for reasons we are all painfully aware of, but some reforms have been obtained, so it's not completely blocked. And I think that the sooner we realize that this is the only game in town, namely, this is the only channel that can save the planet as well as address some other key problems, the sooner we realize that, the better off we will be.
Right. Well, thank you very much indeed. Sadly, very sadly, we are almost out of time now. I'm just going to make a few quick points from the incredibly thoughtful presentations you've given and the incredibly thoughtful 100-odd questions that we now have from the audience. The first point to make is that COVID-19 has not derailed this debate. It has dramatically intensified it. I've seen that from the Moral Money platform at the Financial Times. Our metrics are off the charts right now. I wasn't expecting that, but there clearly is something happening in the zeitgeist which is intensifying this that COVID-19 has played into. Second big point is, however, there is an awful lot that is very controversial in this world, partly because we're seeing a dramatic zeitgeist shift. I sometimes joke it's a bit like the medieval Reformation of the Catholic Church, but also because we're seeing a cottage industry try to grow up into a massive professional sector almost overnight. And like any area of finance, and we've seen this pattern in venture capital, leveraged finance, credit derivatives, when you take a fragmented, opaque cottage industry with label confusion and try and turn it into a big edifice, that is extremely difficult and controversial. And I personally think there's a risk that if it doesn't get right, there will end up being, at best, misunderstandings, at worst, scandals. Thirdly, it does seem to me that the era of radical transparency, the loss of faith in government, is playing a big role in the shifting zeitgeist. And I also, for what it's worth, believe very strongly in what Professor Edmans said, that the ESG acronym is a reaction to another acronym, which is VUCA: volatility, uncertainty, complexity, and ambiguity. And what you're seeing are people basically saying that they want a way to navigate in a world, which leads me to my last point, which is that one way to capture what's happening, and I think bring together both Professor Bebchuk's point and Professor Edmans, is that the 20th century was marked by an era of tunnel vision, where people thought it was acceptable to use intellectual tools that were bounded and focused and directed. And one reason we talk about externalities was that everything which wasn't inside the bounded model in economics was external and essentially was discounted. What's happening in corporate finance and economics and almost every other area of life is the stuff that was external is now becoming part of the model, in fact, if not the model. So we're moving from tunnel vision to lateral vision. And that's quite a profound shift. And the debate between Professor Bebchuk and Professor Edmans really is about how do you best implement that shift in an effective way or not. Last point, and we sadly are out of time, is that there is a lot more to discuss. Clearly, this audience has voracious demand to have more discussion on this. We've now actually exceeded the limits of the questions that Zoom can cope with. And so my last big plea, apart from saying thank you to the brilliant debaters, thank you to the organizers, my last big plea is please can we regroup with this very long list of questions as our homework. And I hope they can be emailed out or at least posted in a way that everyone can see, because this really is not the end of the debate. It's really the beginning of a much bigger debate going forward that we're certainly dedicated to covering at Moral Money. So thank you all very much indeed, and best of luck in figuring it out.
Thank you very much.
Thank you.